Vineet Sambre, who's usually a very, how do I say, a conservative, value-oriented investor, finds this to be the big one, which could actually spur earnings, momentum, and sales. He joins in right now, Head Equities, DSP Mutual Fund. Vineet, great having you. Thanks for joining in. What do you guys at DSP and what do you personally, Vineet, make of this move taken yesterday?
So I think this is, I would say that this was required in a way because we were seeing that overall, when you, let's say, benchmark broad mass consumption, essential consumption with FMCG, with the entry level two-wheelers or automobile segment, then broadly, the last 1 year or even beyond that was not actually showing, great demand momentum. And despite what the government had done in terms of the income tax benefits or the interest rate cut, we were still not really seeing that momentum coming back. So from that perspective, I think this is a good combo, I can say, coming out in terms of the government policy framework, right from the announcement of interest rate coming down, the income tax benefit, now the GST. I believe that this should start benefiting the demand eventually from here onwards, or maybe from the festival season onwards. And that would mean that overall the growth which was impacted should then start seeing some turnaround. Now, the other important thing to sort of also remember is that when we were analyzing data for the top 500 companies, what we realize is that the wage growth has been pretty poor for the financial year 25 as compared to a couple of the last 2-3 years where the wage growth has been pretty high at 12-13%, and we are seeing the employment generation from the large segment, which is the IT, has also not happened in a meaningful manner. So I think that's an offset. This is going to gradually maybe lead to improvisation, and eventually the broader part of the economy should do well, and then the employment and the other stuff. But I would imagine that it's not going to be a immediate knee-jerk kind of a strong reaction. This is a good move. And I think this will have a good long-term implication from the overall demand perspective.
Okay, Gautam Duggad also joining in this morning. He's head of research at Motilal Oswal. Gautam, very good morning to you. I'm sure you were up all night crunching numbers and doing the calculation because the Prime Minister unleashed this, post 10 p.m. What is the conclusion that you've come to? What does this mean for markets that have really been trying to find their feet?
Good morning, Tamanna. Thanks for having me. More than happy to stay awake if more such measures come in future, because we really need them. Still, we have to look at it in conjunction with some of the steps that the government and RBI have already taken. So, they've cut rates, they've cut income tax rates also, interest rates have been cut by RBI, liquidity has been infused, and now this big bang, because this, I would reckon, is the best and the biggest reform step that the Modi 3.0 administration has taken. And we had the fortune of having Mr. Piyush Goyal at our conference 2 days back, wherein he enlisted that there are more steps that are on the anvil. And Prime Minister himself has mentioned that there is an arsenal of reforms that he's going to unleash. So we are all waiting for that. But this is a very big move. This is the first time the government is prioritizing consumption in its 11-year tenure so far. I mean, Modi 1.0, 2.0 was all about infrastructure, capex, manufacturing, PLI schemes. The real push to consumption has started coming in 2025, first with the budget and now with this GST cuts. This encompasses so many sectors and will have direct as well as indirect impact on consumption going forward. So you are seeing the reaction in those sector-specific stocks. And at the same time, there's also bolsters sentiment, which has been lackluster for some point of time now, given the way markets have been behaving and given the way earnings were flat in FY25.
Of course. So outlook for, the Nifty, as well as some of the biggest beneficiaries in your view, Gautam?
So consumption, obviously, auto is the biggest beneficiary. We were lucky in upgrading auto in July when we did our preview. So Maruti, M&M, Hyundai, all sorts of stocks are benefiting. Retail will also benefit as the consumption demand spurs. Naturally, FMCG, you are seeing the reaction in FMCG stocks. 7-8% price cuts could help volume to recover. You have big beneficiaries in insurance. So this is very sector specific, but I don't want to limit this tape to, just, something has been announced, you look at the stocks for a day or two, and then you move forward. I think this is far bigger in terms of the signal that the government is giving, and therefore it should have repercussions for equity multiples as well, because sooner or later it will have an impact on inflation, cost of money, and that will then in turn have impact on equity valuations. The only thing missing in the entire equation was earnings growth, which I'm hopeful this year we should at least get 8 to 12% earnings growth, which was zero last year. And first quarter has begun on a decent note. More, specifically, if I were to highlight, we were quite, surprised by the strength in the mid cap earnings, which has outperformed expectations. And we've actually seen earnings upgrade in mid caps, whereas in large caps and small caps, we saw earnings cut. This was the expectation, we had a couple of quarters back, that mid caps will continue to outperform large caps on earnings. This is the fifth quarter in a row that has happened.
Okay, Gautam, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us your thoughts very quickly. Vineet, the management conversations that we've had thus far, and naturally all of them were consumer facing, but for maybe a cement company which came in because they also have seen this benefit, and maybe some people say real estate companies might actually benefit more versus cement because the input cost for them goes down. But I'm just trying to understand, when you look at the plethora of themes on which there have been changes, what are the ones that to your mind stand to benefit the most, where demand may be elastic and the uptick in demand may be more durable than others, if you will?
So I think clearly from the GST reduction perspective or rationalization perspective, auto comes out as one of the bigger beneficiaries, because I can definitely see the change over the course of last 4-5 years, as we went through these regulatory changes. The price points started going up for the entry level, maybe bikes, cars. We have seen the demand, stagnating for these categories, and I think pricing is a most important factor driving the momentum out there. So I would imagine that once the price reduction takes place here, this should be one of the categories to look forward to in terms of the overall outcomes becoming positive. On the other hand, you spoke about cement, but I'm not very sure about cement, because most likelihood, that's one category which is not so price sensitive as such in a way. And maybe we have already seen some bit of price increases happening before the event, because I think the companies were also in a way preparing to maybe at least have a neutral kind of framework post if they have to reduce the price. I think cement in itself, in general, the demand should remain sound, because I believe the real estate market is in a good shape today, and the data points which are coming out in terms of the sales, the absorption, and all that is pretty okay. So, but I would not call that as a very elastic kind of a demand where cement will suddenly go for a big increase in terms of the volumes. So I think auto, and the other thing in my mind is the banks, maybe NBFCs more, because I believe that it's a combination of interest rates actually benefits coming through, the whole consumption actually again improving. I think that should lead to good demand environment for the credit growth, because credit growth has already come down below our nominal GDP. In fact, nominal GDP now first quarter was low, but I think the credit growth has a better matrix in terms of the outcome as well. So I think these two at the moment top of my mind I can think about.
Vineet, for people who are watching right now, and if there are investors who are sitting on cash because of the uncertainty out there, is this a right time to bulk up on a GST ready portfolio, or would you wait on the sidelines? Just what is the investment philosophy right now after everything that we've seen last evening?
So I don't know, markets have always been so uncorrelated last few years. It's very difficult to call out. But let me say that I think we are still going to see some bit of more offsetting news flows around the tariffs, maybe how the demand really shapes up. We still have the September quarter, which may still not show the whole implication, and we may still see a slowdown. So I would say that it's always a good merit when we are going through these phases, and especially our markets have in a way recognized some of these. When you look at the price points last couple of days since the time announcement has happened from the Prime Minister, I think the markets have really caught up to some extent. So I think it's okay to have a gradual way of investment. I'm not negative on the markets. I feel these are all good changes which has happened, but investors should try to invest more gradually on a systematic manner, because there are these volatilities, plus markets to some extent has also priced in some of these positive changes.
All right, thank you so much, Gautam, Vineet, for speaking with us today.